Welcome to the elective course Stock Market Operations run by Department of Commerce, University of Kerala. So the topic which is given in the syllabus, that is why investing, what is the purpose of investment, why people go for investments, etc. So we can look on this topic, why investing. So, ways to make money. Everybody is looking to get money or create money, create wealth. So, I think the human beings are focusing on getting creation of wealth. They are emphasis on the creation of wealth. So there are two ways to make money. First way is to earn an income either by working for yourself or for someone else. We have to work with somebody, or we can have our own venture to get money. So that's the one way to make the money. The other way to grow your fortune is to invest your assets so that they can increase the value or worth over a period of time. So one of the ways to increase the money to work job, that will create employment, job or entrepreneurship, etc. will create increase money. And other ways to increase money is investment. The major, the famous investors, Warren Buffett, etc. These people are concentrated in investment rather than job. So their main purpose is investment. Their main job is investment. So whether you invest in stocks, bonds, mutual funds, options, futures, precious metals, real estate, small business. Small business means you are financing small business, like green finance, crowdfunding, etc. So we can look on these jargons or concepts later, part of the course. And the objective of this investment to generate cash. And recently, cryptocurrencies are also come into the field. Now we can invest cryptocurrencies like Bitcoin, etc. So this cash come in the form of increased value to the investment, and the return which comes out of the investment may be capital appreciation. So when you invest Bitcoin, after 1 year, what will be the appreciation? When you invest shares, what will be the appreciation? So that is a return of investment. Apart from the appreciation, if you invest shares or mutual funds, you will get dividend income also. So while you consider investment, your main focus is on return factor, risk factor, and liquidity. So the investment should be liquidity. So these factors are all considered while making investments. So if somebody asks what is the goal of investment, why you people invest? So the goal of investment is to put your money to working on one or more types of investment vehicle. We have a lot of investment vehicle, shares, debentures, bonds, exchange traded funds, Bitcoin, cryptocurrencies, gold, real estate. So we have put money into these investment vehicles and hopes it grows over a period of time. So our expectation is to increase in the capital appreciation from this investment. There is a risk factor associated with, so there is a sufficient planning to be essential before investment. So needs of investment. In individual investment goals depends on his or her income, age, and risk tolerance. So there is a demographic variation in the concept of investment. There are people, higher income, richer class people, middle income group people, and lower income group people. Their investment styles are different, and age-wise also investment is different. So your youngsters they are interested to take risk. So they are interested to invest in this kind of new platforms, these cryptocurrencies, derivatives, etc. Even though it is risk, and their age explains the risk. And some of the retired people, they are preferring this type of defensive stocks or bonds, because they are safe in terms of providence of returns. So the income, age, and risk tolerance is different. So making regular investment forces you to set aside a sum regularly, thereby helping you a sense of financial discipline in the long run. So a regular investment create a financial discipline, and it will help to achieve something in the future. So that is the main purpose of investment, main need of investment. So this investment create a financial discipline, and this financial discipline definitely help for the future life, and also accomplish something in the life. So savings versus investment. Some people rely on savings rather than investing. So the term concept, the savings and investment are differs, and the savings is different from investment. Some people are concentrated on savings rather than investment. These people are called defensive people, and they don't want to take risk. But in fact, however, in a dynamic world, savings may not be adequate to guarantee continued financial security. If you save in a savings bank or fixed deposit, you will get a limited return only. So that return is not apt or not appropriate uh, in the living conditions of the country. So idle money in lockers. Some people keep money in lockers. Some people keep money in bank account, savings bank as well as fixed deposit. May not serve the purpose because the current rate of inflation in the country may be 7 to 8%. So that means the money value is decreasing 7 to 8%. But what would be the impact when the fixed deposit provides 7 to 8% return? The current rate of inflation is similar to 7 to 8%. So it does not serve the purpose, because the interest which we get from the fixed deposit is exactly compensated with the inflation. So the real rate of return is zero. So inflation kills the interest derived from the savings. So that we can say that the savings is not appropriate in the dynamic world. So we have to go for the investment. Investment could help beat inflation, because current rate of return of equity shares in Indian stock market is 35 to 40% average return provided by the stock market investment. The same time, the fixed deposit offers 7% and the savings deposit offers 4% in savings. So there is a drastic difference between the savings and investment. So you can feel that, but there is an awareness, there is a knowledge, there is a literacy over the investment to capture the impact of this investment rather than savings. The power of compounding also assists in wealth creation. Investment, there is a hidden impact, that is compounding. So what you invested, its compounding effect is there. We will look on this compounding effect later. So the compounding effect is very important in investment, which is completely absent in savings. So investment is further helpful in meeting future goals such as purchasing a house, going on a foreign vacation, or planning your retirement, etc. So if you wanted to visit foreign countries, you can save, invest right now. So you wanted to, your kids is going to be foreign education, you can plan like you wanted to purchase a house, you can plan like that. And you wanted to go for a foreign vacation, you can plan for the investment. So everything can be planned through investment, and we can achieve these things. As I said, the inflation is a very critical factor in savings, so that we people need to go for investment rather than savings. So impact of inflation and the importance of investing. So when there is a rise in the inflation rate, you may fewer things with the same amount of money. So when the inflation goes up, current rate of inflation, for example, it's 7% in the consumer goods. So you can buy goods of rupees 100 right now, and the next year the same 100 rupees is equal to, if the rate of inflation is 7%, if the 100 rupees is equal to 93 only, because 7%, 100 into 7 divided by 100, that is 7 rupees. 7 would be reduced to next year. That means today's 100 is equal to next year's 93 rupees. This is called inflation. This will affect the your purchasing everything. So we have to calculate the inflation rate of the country and act accordingly, so that we can be a success in our life, because we have to overcome the inflation effect, because every country the inflation in presence of inflation is there. You can take the example of petrol, diesel. Every day the price is increasing. So the currency, the money gets to us remains the same. So we have to adjust the inflation through the investment. That is a modus operandi here. So you have no control over the inflation rate. If you are to stay ahead of inflation, you need to have more money to purchase the extent of goods you need to in the future with the money you have today. So if you are to stay ahead of inflation, you need to have more money to purchase the extent of the goods you intend to in the future with the money you have today. So for adjusting the inflation, for overcoming the inflation, you have to have more money than right now. So this more money can be derived through investment. But money doesn't grow on its own. If your money has to grow, then it has to earn returns. So the returns is very important. Your money should get returns. Your money should provide returns. So that return percentage, savings return percentage is 4% and fixed deposit is 8% maximum. But these in stock market provides the return on an average 25%. So there is a drastic difference between the interest rate offered by savings and these stocks. So to earn returns, you need to invest. Therefore, making investment is necessary to tackle inflation. So inflation at the rate of 8% means you need 8% more money than what you have to purchase the same item next year. So this I explained just before. So this table shows the effect of 1 lakh rupees if the current rate of inflation is 8%. That means this year 1 lakh is next year's 92,000. This year 1 lakh is after 2 years 84,640. This year 1 lakh is equal to after 3 years 77,869. So similarly, we can compare the 1 lakh value after 8 years is 51,322. That means inflation kills the value of currency. So for overcoming this effect, we have to have a proper investment. Otherwise, we'll be in trouble, and we will lose a great control over the life. Next, managing investment goals. An individual investment goals depends on factors that may include age, income, and risk profile. Already discussed that is age-wise the investment are different, and income-wise the type of investment are different, and risk profiles also different. So age can be further subdivided into following 3 categories. Means the types of investors. Age-wise, young and starting out in a career, and middle-aged and family-building people, and retirement age and self-directed. All these stages, the nature of investment differs. So the character of the people, or the nature of the people, or the rationality of the people differs during various life cycles. So a youngster's investment agenda is different from the middle-aged people investment agenda, and retirement age people investment agenda is also different. So investment wise, these people, because the rationality maybe differs, because after the people's experience, rationality differs across the age. So next is factors to consider before investing. So there are a lot of factors are to be considered before investing. It is not like everybody looks on share market investment. Not everybody looks mutual funds. So people can think and plan what would be their investment avenue. So that planning is very important. So there are many factors to consider before investing. Some people, investing in startups only. They are giving finance to the startups. So some people, their agenda is to make investment in equity shares. So they have diversified portfolio of companies, and they will be maintain that portfolio, and they will review the portfolio and they're making the returns. So investment avenues are different. So people can have the freedom to choose the investment avenue, but you should consider a lot of planning and return aspect, liquidity. So overall, we should not be put into a trouble while in the process of investment. So that is very important. So investment are made to meet short-term financial goals as well as long-term financial goals. So investment are made to create future capital. Investment are made keeping in mind a target return on investment. Investments include buying bonds, equities, real estate, and so on. Business investments are in plant and machinery, labor, research and development activities, real estate. So business and corporates investing in this research and development, etc. So similarly, the construction of an asset, namely factory or plant and building, would be also part of an investment. So an individual choice to spend money and pursue higher education is also an investment. Now you are in higher education, this higher education, you are doing a course, is a part of investment because you are investing money and time. So it is a part of investment, and you can develop some skills after this program. So you are studying a course, you are studying a program. After the program, the outcome is to develop some skills, and the skills will helpful for you for the future life. So that is the concept of education. So you are now invested in higher education, the higher education provided by the Kerala University. Okay. So this slide, we can categorize the different types of investment avenues according to activeness and passiveness. Activeness means we have to be active in the process of investment. We have to be vigilant always. That means we have to get the knowledge. If, for example, if we investing in shares, so we have to look on the company's perceptions, company's activities of the company, those companies in which we have invested. So it's very important to get the knowledge. Means a high knowledge person will get more benefit than the low knowledge person in the investment. So knowledge is very important. So that knowledge create activeness, or activeness, we have to review the stocks we invested. That means if the stock is not performing well, we have to sell it off and purchase a new one. So that is activeness. Passiveness means simply if we put money in bank deposit, just we can sleep. Okay, no issues. The bank will give the return, but the return is so minimum, like in fixed deposit maximum you will get 8%. If your money is put in the savings bank account, it will get only 4%. So direct equity is very active, and the return is very high, and the return, inflation potential to beat inflation is also very high, and the risk is also high. So there is a positive relationship between return and risk. If the return is high, of course the risk is also high. If the return is low, the risk is also low. So mutual funds, you have schemes, many schemes of mutual funds are available. Some of the schemes are passive, that means same like fixed deposit, but the interest rate is minimum, like you will get only 10%. It's more than the fixed deposit, but it is 10% flat rate. If you put money in the bonds or mutual funds, you can sleep and you will get 10%. But there are schemes, mutual funds. The mutual funds, we can see the concept of mutual funds later. It's a very important, very good investment avenue nowadays, because nowadays amount invested in mutual funds are increasing day by day. So that is a growth of mutual funds, because these funds are invested in equity shares. So there are professionally qualified people, they collect money from us, and these professionally qualified people, asset management companies, investing in company shares. So the knowledge wise, they are superior to us normal investors, so they will get more return, and the part of return they earned will be distributed to us. So that is a concept. So there are active and passive mutual fund schemes. The return potential is high, and we can beat the inflation, and risk is also high. Fixed deposit, it is a very passive investment, and return is low, and potential to beat inflation, it is being return as high, but it is very limited, and risk, no risk. Recurring deposit is passive, moderately low return potential, and we cannot beat the inflation through recurring deposit, and risk, no risk. And public provident fund, it is a passive investment, and return potential is high. This is high means maximum 8.5% is a public provident fund return. and potential to beat inflation low, and risk no risk. The employees provident fund and national pension scheme. So national pension scheme now it's very active, and return potential is moderately high, and potential to beat inflation moderately high, and risk involved is moderate. So, there are some investment tips we have to follow while in the process of investment. Choose investment carefully after doing adequate research. So, this research, adequate research is very important. So, before making investment, we have to undertake a research. Research means some knowledge creation. So, we have to study about the investment we are going to apply the money. So that is very important, and don't be biased. This bias is very important. There is a systematic discipline, academic discipline, which is emerging right now, that is behavioral biases of investors. So, the demographic factors itself different, age-wise, sex-wise, income-wise, location-wise. The investment is different, and investor are also different in this demographic wise differences. We can feel that. So, there are people. Recently, we have experienced that the last May month, there is a person who Elon Musk, richest person in the world. Elon Musk tweeted that his company Tesla don't consider Bitcoin as a currency. Soon after his tweets, the Bitcoin prices crashed up. Okay, so means everybody follows. Even people type in the Google that the Bitcoin crash, and we can understand the Google trend in the May months. Exactly the Google trend is tallied with the Bitcoin price crash. That what I'm saying is the qualitative data. The qualitative data means the people who typed the Google search that is Bitcoin crash during this exactly May 17th, which is the correct date in which, I mean, the May 17th and May 18th, the Bitcoin prices were crashed. So the quantitative data exactly tallied with the search by the people about the keywords such as Bitcoin crash. So this shows that the behavioral biases of the people influence the investments, and these investment avenues price decreases. So a suggestion, a tips, don't be biased. So investment will be a long-term investment, buy and hold. So a sudden panic is not a solution for the investment. Better investment. So don't be biased. Do not follow others. That is also important. It's a herding. The bias is called herding effect. So some people follow others. If somebody purchases the shares, the others also purchase. That is not a good habit of investment. So with our own research, our own knowledge, we have to take decisions, not follow others. So review your stock and mutual funds investment periodically. So it's very important. You have to review your investments, performance of the investment. You can review your performance of the investment. So consider the tax implications on returns you can earn on your investments. Some of the investments returns are subject to tax. You have to pay tax. So the amount you have given in the form of taxes you have to consider. So whether the investment returns are the tax rate is more, or you have to revise the investment with the less tax. Means the government always promote investment. That means the government taxation policy changes every year. So some of the investments are free from the tax. Some of the investment returns are not free from the tax. So we have to have a chance to opt investment returns with low rate of tax. That would be great. So keep things simple and avoid complicated investment that you don't understand. Very important. Some of the people are, for example, some of the people do not understand the options and features or derivatives. So still they are going into this investment is not good. So they don't understand the modus operandi of the system. So how they can work on with the investment. So the thing is, keep things simple and avoid complicated investment. Which investment you approach, that would be as simple as possible, and we have to have a clear understanding of the system of that investment. So that is needed. So the sooner you start, the better. So start the investment soon after getting on regular income. So very important tips of investment. So you have to start the investment as soon as you get the job. So if you get the job in 24 years or 25 years, you can start the investment. Then continuously investing it. This is also important, diversification. Diversification means do not put all eggs into one basket. Diversify and reduce the risk. So do not put all in the eggs into one basket means do not put all your money in one type of investment, one avenue. So you can diversify investment. Even when you invest in equity shares, you can diversify into different categories. So we have different stocks, I mean banking stocks, information technology stock, real estate stocks, pharma stocks. So we have to have a criteria that is diversification of investment. If we put all money in banking stock, then there is a problem with the banking sector. The all money will be lost. So we have to have a criteria that is diversified investment. Or else we can say that do not put all eggs into shares and do not put all money into shares. So we can have, you can invest in shares, we can invest in bonds, we can invest in gold, we can invest in real estate, etc., etc. So some part of money have to be invested in various avenues. That is a good tendency of investment, which is called as diversification. So here your course, that is stock market operations. We are focusing more on the stock market operations and how we can get return from the stock market operations. And this course learn you how to invest properly in stock market and how to get the returns. Stock market means it covers shares, debentures, derivatives, mutual funds, etc. So you will create the outcome of the course is like that you can create a skill of investment, better investment in stock market, I mean shares, I mean cash market as well as derivative market, and it also considers investment in mutual funds and exchange traded funds. So definitely we hope that you can create a skill of better investment. So already explained the different types of investors. Some investors want to take an active hand in managing their money growth. So some of the people there individually himself, they do investment, they do research, they have proper interest in investment, they do read business newspapers, economic times, business line, etc., and understand the scenario of investment, understand which stock is good. So they will invest accordingly. Some people, they set it and forget it, just invest and they vanished up. And this is a very risky tendency. So if you invest, you have to be vigilant on the investment in which where did the money invested. So we have to be careful on the avenues in which we are invested. So this second one, some prefer to set it and forget it. It's not a good tendency. And some investors, they prefer the brokers or asset management company. They always approach some third party for maintenance of their investment. Maybe richer people, so they approach these brokers and asset management. They are managing the investment of these people and guide to invest in stocks, bonds, exchange traded funds, index funds, mutual funds, etc. So we can give money to these people and these people invest money in different stocks and we will get returns. So three types of investors. One type in which the person who himself do entire thing, investment, research, etc. And second one is invest it and forget it. It's very risky tendency, and I would say that this particular thing is suitable for the savings only, not suitable for investment. This scenario. And the third one, these investors approach brokers and asset management companies. These asset management companies or brokers are institutions. They have sound research, they have sound knowledge, and they will guide the investors for investment in stocks, bonds, exchange traded funds, index funds, mutual funds, etc. So this may be the last slide of this class. Avenues of investing money in India. There are a lot of avenues: fixed deposit, mutual fund, shares, debentures, ETF, cryptocurrencies, foreign currencies, bonds, national pension scheme, post office, gold, real estate, etc. So we can have different options. So here this particular course is concentrated on stock market investment. So we can look the details of stock market investment in the coming classes. Thank you.